Hello, namaste, and a very good evening, everyone. Welcome to our Equity Market Insight webinar, where we decode the latest market developments and also take a closer look at one of our fund strategies. I'm Sonal Mittal, Product Specialist at UTI, and I'm delighted to be joined by Mr. Vetri Subramaniam, our MD and CEO designate, who will share his perspectives on the markets and the macros. Following that, Mr. Nitin Jain, Fund Manager, will walk us through the investment approach and strategy of UTI Small Cap Fund. As always, we encourage you to share your questions anytime during the link provided, and we'll be happy to take them up in this session. With that, let's turn to Mr. Vetri. Welcome once again, Vetri.
Thank you, Sonal. Good evening to everybody. Thank you for joining us here on this Equity Market Insight for December. And before you know it, we are already in the last month of the year and the calendar will soon turn over to 2026. But anyway, we have a lot of ground to cover today. And of course, as Sonal mentioned, today I'm delighted to have on this call with me Nitin Jain. He is one of our youngest fund managers, literally. He joined UTI in 2018. He has covered the IT sector, oil and gas, so two very disparate sectors. And now he leads the UTI Small Cap Fund and also the UTI Innovation Fund. So you'll hear about the Small Cap Fund later. But Sonal, we can get going with today's discussion.
Yeah, sure, Vetri. Starting with the global dynamics. Given the current global trade dynamics, how do you see China's stance in export markets evolving? Do you expect it to soften in the near term?
Sure. Those of you who saw the news yesterday may have noticed, we can move to the next slide, may have noticed China's statement. I think it came out yesterday or maybe day before yesterday, late night, where they announced that in the first 11 months of this year, so 2025, their exports have exceeded $1 trillion. That is a fairly remarkable number. Just for the record, currently there are, I think, only about 19 countries who have a GDP of more than $1 trillion. And here you have the world's second largest economy, which has now reported that in just 11 months, they have exceeded $1 trillion of exports. And if you look at the slide over here, it's interesting. So China's export growth has continued to hold up. If you look at the left-hand side, what you will see is that the Chinese export engine, particularly exports to the US, actually had started to slow down even during the Trump first term. That has continued to accelerate in this current year. However, their exports to the EU and particularly to ASEAN have actually accelerated upwards quite dramatically. Is this because they have managed to shift some of their goods exports to other geographies? Maybe, we don't know. Maybe they've also taken market share in other geographies. But net, they don't seem to have been impacted too much by this entire tariff battle with the US. In any case, their tariffs have now been set at a much more reasonable level rather than the 130, 150% that was being discussed. Interestingly, when you look at their balance of payments, which is a combination of goods exports, services exports, FDI, portfolio flows, and other investment flows, what we find is that their balance of payment is positive, but actually all elements other than goods exports are negative. So yes, it is true that China is a dominant exporter, but it is a dominant exporter of goods. It's a net importer of services. It is actually an exporter of FDI and capital through the portfolio route at this point of time. So its balance of positive is not necessarily that strong as you would imagine in an economy which has such strong goods exports. But we can move on to look at another facet of this exports growth. And if you can see this on the next slide, China has given many incentives to a whole vast range of industries. You can see the range of industries on the right side. These are just some of them. There are many more, but many of these, like solar modules, lithium, all of the electric vehicles, all of these benefit from state incentives. And on the left-hand side, you can see the total quantum of industrial subsidies as a percentage of firm revenues. You can look at that and see that almost 3% of firm revenues in China come from a combination of grants, income tax concessions, and below market cost borrowings. If, for example, you take India, you could argue that today we barely extend any significant income tax concessions. All borrowings typically have to be done at market rate. Yes, through PLI, we are providing an incentive to industries. But remember, in China's case, this is provided to a much wider range of industries. As a result of that, China has built capacities in which its capacity is now larger than total global demand. So if you look at the right-hand side, China's solar module capacity is 150% of global demand. In lithium batteries, they are 130% of global demand. Construction machinery, air conditioners, electric vehicles, their capacity is more than 100% of global demand. These effective incentives that the state has been giving their industry has resulted in them creating large amount of capacity. That capacity is now being exported across the world. That's the powerhouse that you saw on the previous slide. And it also causes very weak pricing trends in many of these product lines. If you look at the next slide, this is interesting because you would presume that if China is growing so strongly, it should actually be seeing a rising labor force and strong wage growth. Neither of this is actually happening. If you look at the left-hand side, actually China's labor force is already on a reducing trend. Look at that bars, on the left-hand side, which is the economically active population. You can see that those bars are actually declining. And we do know that China, total population has started to decline only 2 years ago, but the economically active population has been declining almost for a decade. Despite that, they are continuing to grow strongly in terms of exports and production. Interestingly, if you think that the labor force is shrinking, wage growth should have started to go up. But on the right-hand side, what you see is that even wage growth is not going up. So somehow they seem to have managed this industrialization and increase in output using automation. Also, increasingly, a lot of their exports are coming in high-tech sectors, which are not labor intensive. And as a result, you've got this unusual combination of rising exports, a workforce which is shrinking, and wage growth is also shrinking, which is one reason why sometimes we look at the Chinese consumption data and wonder why it is not showing more strength. But in a way, all of this could lead us to that same argument. Moving on to the next slide, handing it back to you, Sonar. I think you're on mute, Sonar.
Yeah, thanks, Vetri. That's very insightful. Let me move to the next question of interest. There has been a lot of movement in currencies in the recent times. USD is depreciating. Closer home, rupee touched 90 per USD, an all-time low. In fact, China yuan has depreciated versus most other major economies, currencies. How do you assess this having an impact on world trade?
So that's an interesting question, Sonal. And you would presume that a country who is exporting so much, its currency should actually be strengthening. But actually, the data is showing something opposite. And you can see this particular slide, which actually shows you the recent trend in their currency. This is essentially compared to December 2024. And strangely enough, their currency seems to have depreciated against most currencies. In fact, the only exception, the significant exception is actually the rupee. So the Chinese yen has actually appreciated against the rupee. In a way, that's good for India because it makes us more competitive vis-a-vis China. But Funnily, if you look at this slide, it tells you that this Chinese yuan has been weakening against most other global currencies, which either means that it makes their companies more, comparative against all of them, and that's again feeding into the export advantage that they have. So, historically, we would say that when a country has a strong export advantage, it has large surpluses, its currency should start to appreciate. That's the way in which markets readjust. But in the case of China, it is not happening. The currency remains weak. And only in the Indian context, we could argue that we have a comparative advantage. We are gaining some comparative advantage vis-a-vis China because the yuan has appreciated against the INR.
Uh, Sure, Vetri. With those thoughts on currency, let me shift to another asset class that has been in focus recently. Gold has moved up sharply over the last couple of years, and Indians have a natural affinity for owning gold. How does this trend impact us as households and as investors?
Very interesting, Sonal. Indian households are the biggest buyers of gold. And in fact, the World Gold Council estimates that Indian households have almost 35,000 tons of gold. You can pull up a slide on that. And if you take those 35,000 tons of gold at recent prices, it would amount to almost 90% of India's GDP. I'm just benchmarking it to GDP. Obviously, GDP is a flow data, gold is stock data, but it just tells you how significant gold is in terms of the asset value that it contributes to Indian households. And on this slide, what you can see is the amount of gold that the Indian households have been buying, and the red is the amount that they have spent, and then the gray starts to show you the appreciation which is kicking in on account of those gold purchases because gold prices have gone up. And as you can see, by the time you get to 2026, the gold price that Indians have paid in the last 10 years is only half the current value of the gold that they have purchased. So, or the market value of the gold that they hold. So, will this create a wealth effect? Hard to say. We don't have enough documented evidence, but certainly it should cause Indian households to feel slightly better about themselves because, in any household balance sheet, you've got capital, you've got liabilities, you've got assets. And when the assets increase mark to market, it does cause the capital account to also see a increase. So this is certainly a case of increase in gold benefiting the Indian household significantly. The other reason I want to highlight this benefit that the Indian households are experiencing, Sonal, is actually on the next slide. If you see this next slide, and this has been pointed out by many commentators, that actually household debt in India as a percentage of GDP has actually been climbing in recent years. Of course, compared to other emerging market economies, we are still much lower. December 24, household debt as a percentage of GDP is 42%. Emerging market economies are closer to 47%. But as you can see, over the last 7-8 years, there has been a consistent increase from below 34% to this 42%. So certainly it has gone up. Also, it has been going up in non-housing loans. It's not just housing loans. So maybe households have also borrowed for consumption reasons. And you can see that on the right-hand side chart, where you can see housing loans, non-housing loans, and agriculture and business loans. And you can see that the non-housing retail loans are the ones which have been growing the fastest, followed by agriculture, then followed by housing. Now, when you borrow to consume, it does cause concerns because, there's no asset which is getting created, unlike in the case of housing. So yes, Indian households have increased leverage. So again, when you think about the household balance sheet, the amount of loans on their books has gone up. They are holding the gold as an asset in their books at cost, but if you actually account for market value, it has gone up even more significantly. So I'm not sure as yet at this point if we have evidence to say that households are maybe realizing some value of their gold, but it gives me some degree of comfort that even though housing leverage has gone up, household leverage has gone up, they do own a very valuable gold. valuable asset which can help them to deleverage if they so choose. And I'm sure that households who are facing some pressures have most probably figured out how they can actually go about leveraging or utilizing the mark to market gains that they have in gold to reduce their actual household leverage. So this is good news from that point of view, that the households have the optionality. Whether they will do it, how they will do it, hard to say, but at least they have the optionality that if they want to reduce their leverage, this large asset which is sitting in their books can now help them to deleverage.
Sure. With those perspectives on gold, let's talk about the interest rate environment, which continues to be a key driver for markets. Given where we are in the cycle, do you think there could be more rate cuts ahead?
Sure, Sonal, we can look at what the inflation data looks like, and you can see over there that inflation has actually dropped, all the way down there at the bottom over there, closer to median inflation is closer to 2%. And the MPC is now estimating the inflation expectations downward closer to about 4%. Some of the cyclicality is because of food prices, but essentially it means that India is now operating at close to inflation target, and you could perhaps see some upturn in inflation, particularly in headline inflation. It is just way too low. But core inflation is still running at about that 4%, which means that, it is giving RBI some comfort. And, that's maybe one reason why we have seen the MPC and RBI, MPC cutting rates and RBI being willing to provide liquidity infusions into the market, because they are getting the comfort from this inflation being well contained.
Uh, sure, Vetri. Let's have a look at where the markets are in terms of market capitalization. So we have been talking about preferring large caps over small and mid caps for some time now. How has this played out, and what have been the key drivers behind the performance differentials?
Sure, Sonal, we can look at some data in that context. This is the first one, which is really showing you market capitalization and how aggregate market capitalization is broken up into large, mid, and then small, right? So currently 68% of total market cap is large cap, 22% is in mid cap, 10% is in small cap. If you look at this chart and it goes all the way back to 2010, essentially you're seeing that the blue line, which reflects the share of market cap in large caps, is continuously declining, and small and mid cap is increasing. Now, to be very fair, there is no way to really say this should be the right number or that should be the wrong number. The reason why mid and small weight cap, weightages are going up is simply because there's been so much more listings happening in the market by way of new companies coming to the market. So obviously mid and small cap has tended to go up, but we'll look later at the valuation data, and the valuation data suggests that not only has the weightage gone up because more companies have come for listing, but they also seem to be trading at a richer valuation as compared to the large cap. So that is the reason to provide this picture to say that, look, something has moved. Some part of it may be structural, some part could be cyclical, and we need to be aware of that in our investment decisions. But I think investment decisions are best taken basis valuation, which we'll talk about later. Sonal, to your other question, you can see the next slide. This shows you the 1-year return of the Nifty 50, the Nifty 100, which is the sort of de facto large cap benchmark, Nifty mid cap 150, which is obviously mid caps, and finally the small cap. You can see that over the last 1 year, a gap has started to open up, the Nifty 50 leading with a plus 6% return, and the Nifty small cap, which is at minus 12% over 1 year. As a result of this, even on a 2-year basis now, the Nifty 50 and Nifty 100 are at about a 12.8% return, which is better than the small cap at a 10% return, but still lagging the Nifty mid cap at a 15.5% return. Now, we've been raising this issue of caution on small caps and mid caps for a while because of valuation. We think this is part of a long-term rebalancing, but again, as I said, we'll talk about valuations later.
Yeah. With those insights and moving further, from your perspectives, how did the markets perform last month, and how are the market valuations shaping up at this point?
Sure, Sonal, we can just look at some of the data. Actually, what we can do, Sonal, we'll just move, because I think market movements people are aware of. We can just move to the earnings slide. Yeah. So if you look at the earnings slide, as you all know, 25 was a bad year for earnings growth, 3%. 26 also not a great year, only about 8%. That's obviously the forecast, March 26. March 27, the estimate is a very healthy plus 17%. Now, this is only for the Nifty 50. And as I've been saying before, when you've got nominal growth in the economy running at just about 9%, remember we got a record GDP print of 8% plus, but nominal GDP was only 9%. That is more closely correlated with corporate revenue growth. If that is the trend line, it becomes slightly difficult to see how companies can deliver on 17% unless there is a huge operating leverage or change in EBITDA margins or net profit margins. But this is the current estimate. But you can see a slowing down in growth, Sonal. If you look at the next slide, this shows you the percentage of companies in the Nifty 500 which have more than 10% revenue growth year on year and more than 10% PAT profit year on year. In the most recent quarter, which got over, we did see some improvement in the revenue growth year on year. Slightly above 50% of the companies had more than 10% year on year profit growth. But on a PAT growth basis, the number is still less than 50%. And what I would look at is that broad trajectory of the line. You can see where these numbers were more than a year ago and where they are today. There is a clear sort of descending trajectory. The high double digit, high teen profit growth for 2027, to my mind, is a little bit of a challenge given the current trajectory that we have for, nominal GDP growth, which is just about, 9%. Even if we factor in some improvement to 10% next year, 10 to 17% profit growth, that is a very big gap, not possible without operating leverage, not possible without a significant expansion in net profit margins. Yeah, Sonal, we can sort of move through to the next few slides on valuation. If you look at the Nifty trailing price to book over here, it is still in the fair value zone. It went down to the exact yellow line, which was the average line, the historical average line. Now it's bounced up from there, but still very much within the fair value zone. Return on equity for the Nifty, after rising sharply from the 2020 pandemic low, has sort of come off those cyclical highs. The next slide shows you the Nifty's mid cap and the small cap. Here, I must say there is still a concern in terms of valuation. Mid cap still in the absolute expensive territory. Small caps not as expensive on just a numerical basis, but relative to their own history, they are also trading in what we would call the expensive zone even today, unlike the large caps. And also keep in mind that both mid caps and large caps in aggregate still trading at a premium to large caps. I've seen it happen in mid caps in my career, but this is really the first time where I'm seeing it consistently holding a premium to large caps. Is that deserved? Is that not deserved? I would tend to believe that, this is more mean reverting. There are reasons why larger companies can typically in aggregate get better valuations compared to the aggregate of small cap valuations. We're not discussing valuations of individual companies. We're discussing the valuations of 250 companies vis-a-vis the valuation of 50 companies. And we look at that, I think the margin of safety still favors large cap over the mid and small cap. Yeah, Sonal. This again shows the yield curve, but I won't spend too much time on this. We can just, move ahead because I think we anyway have the valuation model. You're on mute, Sonal.
My bad. So, Vetri, given those valuations, what is our internal equity valuation index suggesting now, and how should investors interpret it?
Sure. So our equity valuation index, which you can hopefully see now on the slide and on your screen, this is what we have been using in our asset allocation strategies to determine what should be our allocation to equity. And then we use that same indicator to create a map which we can share with you, which gives you a sense of where are we as far as valuations are concerned. Two quick points to make. First of all, this looks only at the Nifty 50. It does not look at the mid and small cap part of the market because we don't have enough history for it. I think the chart is fairly self-evident. Based on where you see the black line, that tells you whether you are in fair value, whether you are in the increase equity allocation zone, or you are in the decrease equity allocation zone. The good news is that today we are still in the fair value zone, and that too you are at the lower end of the fair value zone. So that still gives us comfort. And as I said, once again, this is regarding large caps. How is this equity valuation derived? It's derived from four specific valuation indicators. The first is the price to book. The second is the dividend yield. Third is the price to earnings, and the fourth is a comparison of the price earnings to bond yield. So it is a indicator which takes into account all four factors, and based on that, it determines these color ranges, which you can use these colors to determine how to think about lump sum allocation. If you were to make a lump sum allocation, thinking about this on a probabilistic basis, what could be the kind of return expectations you might have? This you can see on the next slide. So if, for example, you were to invest in the decrease equity allocation zone, which was the red zone at the top of the previous chart, the average 1 year forward return is 3%. That's the number that you see in the green box. And those averages that you see, 3, 6, 12, 14, 36, those are the averages if you were to have invested at every point in time when the indicator was in that particular color zone. As you can see, the best returns are when it was in the dark green area, and the worst returns are when you are in the dark orange area. What you can also see is that the probability of a 1 year negative return is 30% when you are in the dark orange area. The probability of a negative return over a 1 year basis is 0% when you are in the dark green area. So that's the way to use this. It is obviously probabilistic, and we've mentioned over there how investors could think about making lump sum allocations or managing their equity allocations based on which color the indicator is currently positioned at. So that's the thought process as far as aggregate valuations are concerned, Sona. But I'll quickly conclude on the next slide, which is sort of the key summary. We've talked about this. Inflation is benign, and therefore both MPC has the ability to cut rates, and the RBI is supportive in terms of liquidity because inflation is giving them that comfort. Yes, the US Fed has cut rate in December, but it has likely indicated that it will remain at pause for some time now. I think the Indian macros remain reasonably stable. We've talked about this earlier. It is disappointing how the Indian currency has performed, particularly in the context of those allocating capital to India. I don't think they would have expected so much weakness. But as far as India's trade industries are concerned, particularly those who are exporting, the decline in the currency maybe gives them some comfort as they adjust to the changing dynamics of global trade because of what the US is currently doing. We still think we are well on target from a fiscal point of view to achieve 4.4% fiscal deficit target, though government spending might turn softer over the next few months. We've talked earlier about the Max 7. They have become far more volatile. And there have also been shifts in stock price performance. Increasingly, the companies which were seen as being bellwethers of AI, whether it was NVIDIA, whether it is Microsoft, OpenAI, there are more concerns about them, and those concerns are surprisingly coming because of the rise of Google as now being seen as a very comprehensive and a well-positioned player in AI because they are doing everything from solving for the consumer end of AI users like ChatGPT to also designing the chips which could be used to train the LLM. So we are seeing that sort of shift and increase in volatility in the US market. I've already talked about earnings growth and where we are in the equity allocation zone. We still think this is a time for investors to consider asset allocation and risk management more comprehensively. We continue to like hybrid funds, and investors looking to make lump sum should be biased more towards large cap simply because of valuations. The quality growth cycle has still not turned particularly favorable. It has seen some, it is not underperforming value as much as it was at the beginning of 2024, but I would yet say that perhaps it has not completely shifted in favor of quality growth. So maybe we are still in the middle phases of that, or early phases of that is what it appears to be the case. But I'll halt over here and hand over to Nitin, who will then run you through the UTI Small Cap Fund presentation, and then we'll open it up for Q&A. Thank you.
Thank you, Vetri, for sharing your insights. Welcome, Nitin. So, Nitin,
thank you.
Sure. Nitin, my first question is, from an investor's perspective, what value does the small cap theme bring to the table?
Yeah. So, small cap universe provides you exposure to segments which are not present in any of the large caps or mid caps. So, if you can move to the next slide, you can see here the kind of diversified exposure that you get in small cap is typically not present in large caps, and there are many sub segments within those sectors where only small caps provide you exposure. So that's one point. The second point is, can you move to the next slide? So if you see last 10 years of data, means we have this is data from Bloomberg of top 1,000 companies by market cap. We have divided them into small cap, mid cap, and large cap. Small cap is the bottom 750 stocks in that list of 1,000 stocks. So historically, we have seen small cap universe has produced the largest number of multi-baggers. So this is a universe where you can find those stocks which can give you 5x, 10x returns over next 5 to 10 years period. So it gives you opportunity to find those kind of stocks.
Sure. Nitin, while the small cap segment does bring strong opportunities, mostly long term, but it also comes with its own set of considerations. So what are the key challenges or considerations that are there that you associate with the small cap stocks that investors must keep in mind?
Yeah. So while small cap universe gives you a lot of multi-baggers, it comes with its own set of risks. So the probability of going wrong is also very high. What we call as the error of commission. So if you can see the same set of data, means the same set of companies, 750 companies, and we have done this analysis again for the 10-year period, starting from 2015 to 2025. So here you can see almost 162 companies where the investment value has declined by more than 50%. So the kind of more than 50% value destruction has happened in 162 companies. There are 82 companies where they have given between 0 to minus 50% returns. So and 130 companies where the returns have been just between 0 to 100%. This is over 10 years horizon, so that's a very long period. So that way, the stock selection becomes very important. If you select a wrong stock, then there's a possibility that you will end up destroying a lot of value. So that way, the stock, if you commit an error here, the consequences can be very adverse.
Yes.
And the second thing is let's say since the university is so big, we're talking about 750 companies, or even beyond that, means you can go beyond 750 as well. There's so many companies listed. So the investment universe is not as widely covered as some of the large cap and mid cap companies. So this the left hand chart gives you an example. For example, in case of a small cap, the average number of analysts who are covering these companies, if you take those small cap universe, is just 10 analysts. While in case of large cap, every company is being covered by almost 30 or 40 analysts. And the second thing is the institutional ownership is also very low in case of a small cap. So when you're doing research or when you are analyzing any company, you have to do extra diligence on those companies, because those companies are not owned by, in some cases, those are owned by very few institutional shareholders. So you have to do extra level of due diligence on these companies. These are not as well discovered as the large cap and mid cap companies. To deal with this, at UTI, we have a very wide coverage. So as you can see on the right hand side, We cover almost 225 small cap companies. This include the companies in Nifty 250 as well as beyond below basically Nifty 500. So we have wide coverage, and we apply our rigorous set of processes to evaluate all these companies.
Sure, Nitin, with those opportunities and challenges associated with the small caps, how do you narrow down the universe and decide which companies make it into your portfolio?
Yeah. So at the first level, so as I had mentioned, so we have strong processes at UTI in terms of research. So many companies get filtered out at that level itself. And beyond that, when we are analyzing a company, we look for three particular risks, just to uh, basically is the first filter criteria. So that is one is we try to avoid value destroying business models. These are companies where we don't think that these companies can generate a reasonable ROC over a period of time. So we don't see any scope for these companies might be operating at a lower ROC right now, but we don't see any scope for improvement going forward as well. So this is one set of companies where we think business models are not attractive even going forward basis. The second set of companies are where we see balance sheet risks, where there's a large debt sitting on the balance sheet, or we see some unusual items in the balance sheet of the companies, which raise some red flags. And the third is the corporate governance track record of those companies, where we don't have comfort on the management, promoters, or if there are some large related party transactions, all those things. So we tend to filter out those companies from the investable universe. And of the remaining companies which come out of this filter, then we look for multiple factors, including what are the modes of the businesses, scalability of the business, because these are small companies, and we're talking about basically high compounding of businesses. So there should be scalability in the business for this business to compound over 5 to 10 years. Then we look at industry, the business model, ROC profile, cash flows, in terms of the quality of the management, and finally it comes to valuation, whether this company deserves a kind of valuation, and whether we can basically benefit from re-rating or compounding of earnings. So these are the broader factors how we analyze the companies. Then can we go to the next slide? Then we in the fund basically we invest in 4 type of companies in the fund. So the first is category leaders, and generally the focus is on quality and growth. So in most of the companies, we are trying to look for these two attributes, the quality, and they should be high growth companies. Although it's a blend, we also go for some of the opportunities where we think there is deep value, or there are cycle, something is changing in the business. But largely it is on the we look for growth in the businesses. So these are the 4 categories. So one is category leaders. So these are companies which are operating in a particular segment where there is no other company in large cap or mid cap. So for example, I'll give you example of one company later in the presentation. MCX is one such company. There is no other exchange like MCX. You can't find a large cap company like MCX. So these are those category leaders. These companies are define that category. Second is challengers. So basically, these companies operate in the same area where some of the large cap or mid cap companies are operating in, but because of some uniqueness of the business, maybe more aggressive management, or they have found a unique way of doing business. Because of that, they are able to grow much faster than their larger competitors. So these are the challenges. Third set of companies are specialists or pure plays. So basically, these companies are operating in some high growth subsegment. So for example, in consumer, overall industry growth has slowed down significantly. But within consumption, there are certain subsegments which are still growing at very fast pace. So we are trying in this category, we try to find those companies which are operating in those areas, which are very fast growing areas. And hence these companies can grow significantly faster than the category itself, the broader category itself. So this is the third category. And fourth category is more opportunistic kind of stocks where we are seeing significant value. Either these stocks are ignored by the market, not well discovered, or these are cyclical companies where we think they are at the bottom of the cycle, and we have comfort in terms of basically these companies coming out of cycle in a healthy way, and we can play out the cycle. The third, the other thing could be there's some significant change happening in the company because of leadership change or some other strategic changes. So these are the four set of categories where we try to invest. Finally, eventually it comes down to what is the long-term growth potential, margin potential of the business, ROCE, cash flows, and management or quality of the management, and tying all this together, then we decide whether at this particular valuation, whether we can make money on this in these stocks.
Sure, Nitin, that gives us good clarity on your stock picking framework. To help our viewers understand the fund better, could you shed some light on the current portfolio of UTI Small Cap Fund? How is it positioned today?
Can we move to okay, can you move to next slide further? Yeah. So as I mentioned, this is the style of the fund is more growth and quality. So we have tilt towards quality and growth, although we categorize it as a blend, but it's second thing is this is true to the label. So we don't invest in large cap. So you can see the mid top table. 83% exposure of the fund is in small cap and 17% exposure is in mid cap stocks. Some of the small cap stocks which we had bought in the past have grown, have become mid cap, and may potentially become large cap as well. We may continue to hold them, but we don't buy large cap stocks to begin with. So maybe we start with small cap and mid cap, and maybe as they grow, they can become large cap. So we are true to the label. So we restrict ourselves to small cap and mid cap. In terms of active shares, it's given that it's a mid cap, small cap universe is quite large, and we follow a bottom up process in terms of stock selection. So that's why the active share you will see is quite high in this strategy, and that will remain the case. And it's much more diversified. So top 10 holdings are around 21% of the portfolio. On the growth part, as I had mentioned, quality plus growth. So that reflects in slightly higher valuation of the fund. So price to earning ratio of the fund is around 45 times versus benchmark valuation of 41 times. That reflects the growth tilt of the fund. And the return on equity is higher for the fund versus the benchmark, again, reflecting the quality aspect. In terms of sectors, so it's a bottom-up stock selection process which we follow, but there is some sector angle which comes in. So right now we are positive on consumption space. Selectively, we are positive on some pockets of financials within services and IT, particularly some of the BPO businesses. We are seeing emergence of some interesting services businesses including some new age businesses. So we have higher bets in those sectors. And some of the low quality sectors where we don't see sustainable ROC generation or weak cash flow profile, some of those sectors actually get lower allocation from the fund. So power, energy, you will see a lesser allocation to those sectors.
Sure, Nitin. While we had a look at your stock picking framework, we also looked at the current portfolio positioning. Can you also share some examples or illustrations of some of the stock pickings that you would have done?
Okay. Can you go back? Yeah. So maybe I'll give you a couple of examples. So FL3I Limited, this is an advertisement technology company. So this is one of the unique companies, not only in India, even globally. So the business model of the company is that they get paid only when they achieve certain outcomes. So let's say some company like Blinkit or Instamart, they want to get more app downloads, or if they want to, there are customers who come to their app but they don't buy. So they want customers to buy from their app. So Apple will drive that outcome from them, and they will get paid only when that outcome is achieved. And while doing that, while taking that risk, they are still making 20% kind of margins and very decent ROICs. It's a very unique business globally. Very few companies have succeeded in this kind of business model. Apple has shown a track record, and they have grown at almost 25-30% kind of CAGR in revenue over the last 5 years. So we see this as a company which is leveraging technology to grow, generate returns, generate high margins, and scale the business. So that was one example. Second company is MCX, which I talked about earlier. So again, a company which is representing a segment. It's a monopoly in commodities exchange. Almost 99% market share. They're launching newer products, which is driving growth for them. And there's very high operating leverage in the business. So as they grow, the earnings are growing faster than the revenue. Maybe I think this we can move ahead.
Sure. Thanks, Nitin. Can you also walk us through like how the fund has performed, considering that it is now closer to its 5 years term? So how the fund has delivered in this period?
So one unique thing about this UTI Small Cap Fund is, as we discussed it earlier as well, that we have this quality focus. Because of that, the volatility of the fund is much lesser than the benchmark, which is reflected in the table below. So here you can look at the risk-adjusted return of the fund, where we are basically looking at return versus the volatility of the fund. So in most of the years, you will see the fund has delivered a better risk-adjusted return compared to the market, except for one of the years, which was FY24, when everything was up in the market. The benchmark gave some 64% kind of returns. So that was one year where fund had underperformed, but otherwise on risk-adjusted basis, the fund has delivered better returns compared to the benchmark. And this is cumulative. Basically, that was we had divided return by years. This is more on a 3-year rolling return basis. Even here, you can see the risk-adjusted returns on the right-hand side have been better than the benchmark.
Sure. Nitin, so why should investors consider investing in UTI Small Cap Fund? If you can just summarize in 2-3 points.
Yeah. So first of all, as I discussed, it's a true to the label strategy. Means we are investing only in small cap and to some extent mid cap. We are what we are promising. We are investing in those kind of stocks. We have quality focus, quality and growth focus. So that avoids some of the risks which typically happen in case of a small cap universe. So we take care of that through our quality framework. And lastly, it's a well-diversified portfolio. So we have not more than 3% holding in any of the stocks. So yeah, these are the 3 reasons.
Sure. Thank you, Nitin and Vetri, for those valuable insights on the markets and the fund. Let's take up some of the questions that we have received from our audience now. So my first question to you, Vetri. No, there has been some recent panic in AI-themed stocks in the US. Does this development bode well for Indian markets in any way?
Interesting question, Sonal, but these are always very hard to say. If somebody else has a problem, is that good for me? Is really the question somebody is asking. And it may be, it may not be. It really sort of depends. So I wouldn't say that. I think what I would definitely agree to is that the US market has been a magnet for all global capital. Because A, it is so large, B, it has done so well in terms of the economy has done well in terms of growth, and at the same time, this new driver of economic growth, AI, they are literally at the center of the universe as far as that is concerned. But, just like I showed you the share of large caps in the Indian marketplace. If you look at global market cap, currently the US share of global market cap is at a record. It's about, I think, 65 or 66%. Their share of global GDP is only 25%. It's not a stock valuation measure, but it does tells you that maybe something is excessively getting discounted over there. So again, anything which happens in the markets, to be honest, Sonal, which happens in a very dramatic fashion, it's never good for any equity market. So a very dramatic sell-off in the US market for whatever set of reason, my sense is the ripples will go across all markets, because market ripples travel very fast. From an economy point of view, our economy will not suffer too much damage if there is any unwinding of the AI related spending. So from that point of view, I would submit that our economy doesn't get hurt too much, and therefore in the medium to long run, even if there were damage in the US, it really doesn't hurt our growth prospects too much.
Thank you, Vetri. Coming to you, Nitin. We saw in the webinar earlier that the valuations in the mid and small cap segments continue to look stressed. Given that backdrop, why should investors consider UTI Small Cap Fund at this stage of the cycle, and how should they approach investing in it?
So first of all, I agree the valuations are expensive in a small cap. We are seeing some pockets of opportunities after this correction, a recent correction which we have seen. But the best way to invest at this point of time in a small cap is through SIPs. And particularly about UTI Small Cap Fund, since our style is more quality focused. So some of those excesses which got created during last 3-4 years were in low quality companies, which is getting unwinded now. I think that way the fund is well positioned in terms of more focus on quality.
Sure. Staying with the valuations, are they still expensive across the board, or are you seeing some pockets of opportunity?
No, so after this correction of last 12 months or so, we are seeing some pockets of opportunities. So in some segments, we are seeing that companies with good growth profile are available at a much fair valuation now. So we are seeing some pockets of opportunities now versus 12 months ago period when it was difficult to imagine how will we generate positive returns at these levels. Now I can see many more opportunities.
Sure. Coming to you, Vetri, looking at the broader environment, what do you see as the key risks in the market right now?
Sure. If you were to sort of point to the risks in the marketplace, I would, really look at, just the fact that I think as far as earnings growth is concerned, the 16-17% earnings growth looks to be a very high bar, just given that nominal growth rate in the economy is, currently running at sub 10%. So it is less than double digits. That does create complications in terms of trying to grow at such a high level. The good thing is that I think government as well as RBI are doing whatever they can to now turn to provide policy support both on the fiscal side and on the monetary side. Now, normally people would argue that why do you need to support it if anyway you are growing in real terms at 8%? But I think there is an understanding within the system that too low an inflation is also not a good thing. You don't want very high inflation, but very low inflation is also not a good thing for company decisions to borrow, to invest, and to look at the future positively. Some level of inflation is required. So to that extent, I would say it is good that headline inflation it is not necessarily good that headline inflation has dropped to this level of sub 1%. Hopefully our headline and core being closer to 4% will actually create an environment which will be more positive for companies in terms of the way that they think about making investments for the future. So those are the 2 points that I would make. That single point that I would make, that low nominal growth is really a big challenge in terms of corporate earnings, because very low inflation is not good for the economy. I think the only other challenge that I see is once again coming from valuations. As I said, in the large cap space, we have a lot more comfort, but in the small and mid cap space, I continue to believe that the last 4 or 5 years of returns, they have actually borrowed some of their returns from the future. So we should be a little bit more cautious in that domain, that the future returns may be slightly underwhelming because you have already seen the valuation multiple move up so much. So valuations in mid and small, and secondly, low nominal growth are the two things that I worry about. Sonal, you're on mute.
That's hard time. Sorry for that. Continuing on my earlier question itself, since we discussed key risks, so what are the key opportunities that you see in the market right now?
Okay, so if you look at it from an opportunity perspective, as I said, once again, I actually think hybrids are a good way to get exposure to the market, and particularly because you are getting very attractive carry in the fixed income portion of your of the hybrid portfolio. So you've got a very good positive carry on the fixed income component, and at the same time, if the fund has a slightly more large cap bias, then you are still somewhere in the fair value zone. So to my mind, hybrids are a very good way to invest in this market. There are two other reasons to look at hybrid, Sonal. One is that in the hybrid funds, the cost of rebalancing to the investor is limited because the fund manager does the rebalancing themselves based on whatever models etc. they might have, and the cost of that rebalancing in terms of taxation is therefore limited. Even the transaction cost impact is lot lesser for them when they get it done over there. The second thing is that these hybrids also sort of navigate better during a period where there is still some level of uncertainty within the world. So from that point of view, to my mind, the opportunity today in hybrids is attractive. Uh, Again, as I said, because of the positive carry in fixed income and also from the point of view that it rebalances automatically. The other sector where I still, I've been positive for more than a year and a half, and still remain positively inclined on that sector is financials. Across the banking space and elsewhere, I continue to believe that we are at a point where, the significant part of the rates cuts are behind us. We now have an RBI which is willing to pump liquidity in the system. I would see that as a signal that they are now comfortable with the resumption of credit growth. And in an environment where credit growth is running at the low double digits, by the way, that is also required to lift nominal growth back to double digit levels. So to my mind, if you want to play a recovery in nominal growth to double digits, actually credit growth is a good way to do it, and therefore financials becomes a good way to do it. And we all know there is an inbuilt leverage in financials that when they grow faster, their actually earnings growth can also move up much faster. So financials, to my mind, still remain one of my top opportunities in this market environment.
Thanks, Vetri. Nitin, coming to you. We have seen a large number of IPOs over the past year. How do you filter and evaluate which IPOs to invest in for the fund?
So, as a fund house, we have been very selective in terms of participating in the IPOs. See, one of the biggest reasons is most of these companies, either they are from unknown sector, it's completely new sector, which is these companies represent. So you don't have much of background in terms of the segment itself. And with all IPO companies, you don't have much background with the company, even though you know the sector, but you don't know about the management, about the company. So we are very careful in terms of which companies we participate in. The second element is valuation. Many of these companies which got listed in last maybe 1.5 years are coming at very high valuation. So basically, those are the two things which basically we pay a lot of attention to. We are not overpaying for these companies, and there should be something unique, or if there's some other company which we already know, which we have track record in the same sector, then why to participate in a new company within the same sector? So these are the considerations which we take into account, and we are very selective. So, for example, in small cap fund, we invested in last 1 year, we invested in only 4 companies out of so many companies in the small cap universe which came for IPO.
Thanks, Nitin. Considering time, Vetri, my last question is for you. Vetri, as we approach the end of this calendar year, what would be your key advice for our viewers as they look ahead for 2026?
Sure, Sonal. As I've always said, the market doesn't care whether it is the beginning of a new year, a quarter, or your birthday. In the markets, none of this really matters. So the advice has to be, sort of applicable every day. It cannot be advice only for what should I do because the calendar is, about to change to 2026. The markets don't really care whether the calendar is changing or not. So I would say, the good thing that we are seeing this time, Sonal, is that investors are investing in a very disciplined fashion through the SIP route. Now, if you look at somebody doing an SIP over the last 1-2 years, the returns may not look as great as when they see the investments in the fact sheet, showing a 5-year return of the investment. But that's okay because, if the markets are doing nothing and you're investing, that's part of the design of the SIP, which is to say that you invest through the cycle. You will invest in good times, you will invest in average times, you will invest in bad times. All of that put together gives you a cost of investment in terms of valuation, which is somewhere closer to the averages, and that reduces your valuation risk in the marketplace. So really my first sort of advice to investors, which is valid today or any day of the year, would be that the SIP is a good way to invest. Don't look just at what you've earned in the last 1-2 years. If you keep going, it has got the great potential of helping you achieve your financial goals. Second thing is asset allocation. Asset allocation is important. You do need to have the discipline of reviewing your asset allocation to make sure that is aligned with the financial goals that you have. You could do this realignment of the portfolio either when it hits certain triggers in terms of allocation, or it could be a time-based rebalancing of your portfolios. But if you combine systematic investing with a disciplined form of asset allocation, it will help you navigate the risks in investing quite significantly. Now, somebody may ask, how do I take care of the risk of, how do I receive or how do I withdraw some of my gains and capital from the market at a point in time where I don't have income and may not be investing systematically? There is a simple solution to that. You can withdraw systematically from the capital that you have accumulated over a career of earning and investing through systematic withdrawal plans. So, I think all of this can be done. This is eternal advice. It has nothing to do with the change of the year, but that shouldn't halt me from saying that there is certainly something I can say when the calendar is about to change, which is I wish all of you, who are on this webinar with us today, and those of you who've, been with us over the past year, very happy new year. Best wishes to you and your family, your loved ones and your dear ones. And may 2026 be a fantastic year for you. Wishing you health, happiness and good health all in equal measure.
Thank you, Vetri, and thank you, Nitin, for sharing your valuable insights today. On behalf of UTI Mutual Fund, I would like to thank all our viewers for joining us and active participation. We hope you found today's session insightful, both in terms of equity market outlook and strategy for UTI Small Cap Fund. Please share your feedback on the link provided. Thank you once again for being with us. Stay informed, stay invested, and we look forward to seeing you at our next Equity Market Insight webinar. With that, thank you.
Thank you so much.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.